Welcome back to Synaptic Dividends. We're always breaking down new dividend stocks to help you build out that passive income portfolio. So if that's what you're here for, definitely make sure you're subscribed so you never miss one. All right, today we're looking at a company called Roper Technologies. Now, they build all this supercritical software for very specific niche industries. And honestly, on the surface, it might seem like a really weird choice for a dividend channel. But you got to stick with me here, because what's hiding behind its tiny little dividend yield? Well, it might just change how you think about income investing.
Okay, so let's just get it out of the way. The big question, right? A dividend yield of just 0.61%. I know. For a lot of income investors, that's an immediate nope, not for me. But what if, just what if, that tiny yield is actually a disguise for a powerful compounding machine? Could this thing actually be one of the best dividend growth opportunities out there? Well, to find out, we've got to ignore the headline number and really dig in.
And the very first place we always have to look is safety. I mean, before we get excited about growth or anything else for that matter, we have to answer that one fundamental question. Can this company actually afford to pay its dividend?
To do that, we're going to use my absolute favorite metric, the free cash flow payout ratio. Look, you can forget about all those complicated accounting earnings and stuff. This number, it's simple and it is powerful. It tells us in plain English what percentage of a company's actual, real, hard cash profit is being sent out to us, the shareholders, as dividends. And the rule is simple. The lower this number is, the bigger the safety cushion.
So what about Roper? Well, their payout ratio is an incredibly low 14.8%. I mean, that is just exceptionally safe. Think about what that means. For every single dollar of real cash profit the company makes, less than 15 cents goes out to pay the dividend. The other 85 cents, that's kept in-house to reinvest, to innovate, and to grow the business. You know, this isn't just a safe dividend, it's practically a fortress.
Okay, so we've established the dividend is rock solid. Check. But, safety is only half the battle. The real question for a stock like this is this tiny dividend actually growing?
And the answer to that is a huge, resounding yes. Roper has increased its dividend for 32 consecutive years. Now, that's not just some number on a page. That's a track record that puts them in the elite club of Dividend Aristocrats. It shows you there's a deep, multi-decade commitment from the people in charge to consistently reward their long-term shareholders. It's a huge sign of confidence.
And we're not just talking about tiny symbolic increases either. Over the last 5 years, Roper has been growing that dividend at an average clip of about 10% per year. Now this is where we start to solve that puzzle from the beginning. See, a tiny yield today doesn't matter nearly as much if the actual cash you're getting paid is doubling roughly every 7 years. That right there is the power of compounding in action.
All right, so the dividend is safe and it's growing fast. But how does it hold up when things get really ugly out there in the economy? Let's put it through the ultimate stress test. We're going to look at how Roper performed during the 2 worst economic crises of our lifetime.
I want you to just think back for a second to the great financial crisis in 2008, and then the global shutdown during the 2020 pandemic. I mean, these were just brutal periods where countless companies, good companies, were forced to slash or completely get rid of their dividends just to stay afloat. These events were the true test of a business's resilience.
And this right here just brilliantly shows Roper's strength. They didn't just survive these crises, they absolutely thrived. Right in the middle of the 2008 meltdown, they raised their dividend by almost 14%. And then, during all the uncertainty of the pandemic, they delivered another hike of nearly 10%. This just proves that their cash flows are incredibly durable and predictable, no matter what chaos is happening in the wider world.
So, let's bring it all together. Let's answer that question we started with. Is Roper Technologies, with that little starting yield, truly a dividend powerhouse?
Well, the numbers tell a pretty clear story, don't they? The dividend is exceptionally safe, with that payout ratio sitting under 15%. It has an absolutely elite growth history with 32 straight years of raises, and it's proven to be completely crisis-proof. So the verdict is in. Roper isn't a stock for high income today. It's a high-performance compounding machine for building your dividend income for tomorrow.
Now, if you want to go even deeper and really understand the full business model that's driving these incredible numbers, you should check out our in-depth analyses over on our main channel, Synaptic Investing.
And of course, if you found this breakdown helpful, a like is always appreciated. And be sure to subscribe for more deep dives into the numbers that really matter. Thanks for watching.